SMT divergences will not only allow you to gauge the strength or weakness of the market, but it will also allow you to avoid front running of your orders and will improve your trading strategy as a whole. So let's get started. As in today's video, we are going to discuss what is SMT divergence, what are the two categories of SMT divergence, some common SMT divergences in crypto, forex and indices market, high probability way of trading SMT divergences. So first of all, let's study what is SMT divergence. SMT divergence is not an entry or an execution pattern as told to you by most ICT traders. Instead, it is a gauging mechanism as to how strong or weak the corresponding markets are compared to the main market. Let's look at an example to clarify more stuff. We know that Euro USD and GBP USD work in the same direction 90% of the time. And let's suppose you are a Euro specific trader. Now on the 4-hour time frame, you see that Euro has taken out its equal lows on the 4-hour and has closed back inside the range, showing signs of strength. But when you look at GBP USD, you see it hasn't taken out its 4-hour PD array or equal lows. This indicates you that GBP is a stronger pair compared to Euro USD. So while your main market was Euro USD, you start placing longs on GBP USD because it was more stronger and you could start placing longs on the green dot. Also, an important thing to remember here is that SMT in isolation is of no use and will lead to poor win rates. However, if you apply it like I did here with what? With higher time frame PD arrays or equal highs and equal lows, then you will get better results. There are basically two types of SMTs and you have to remember these. First type of SMT is symmetrical correlation. This is the type of divergence when two pairs such as Euro USD and GBP USD, which are known to move in the same direction. Let's suppose Euro is moving down, so we know 98% of the time GBP will also be moving down. When pairs which are moving in the same direction in normal condition start to deviate, for example, Euro takes out its equal lows of the higher time frame PD array, but GBP doesn't take out its equal lows at the higher time frame PD array. This creates a divergence, and the divergence is between pairs which usually move in the same direction, and hence it is called symmetrical correlation. What does this divergence states us? What if our main market was Euro and it took out the equal lows and closed back inside, but GBP USD didn't took out the equal lows and stayed above the higher time frame PD array? This tells us that GBP USD is a stronger pair and we should look for longs at the green arrow or the green dot. So this is basically the first type of SMT divergence, that is symmetrical correlation, and this is the correlation between the pairs that move in the same direction. Now let's come on to the second type of SMT divergence, which is inverse correlation SMT divergence. As you saw earlier that the symmetrical correlation was between pairs that moved in same direction. So inverse correlation SMT divergence is between pairs such as Euro USD and Dixie that are known to move in opposite direction 98% of the times, and when they don't move in the same direction and start to deviate, such as this example which we'll be looking at detail, this is known as inverse correlation SMT divergence. So let's look at the example. Now as you can see on the example, Euro USD took out these equal lows or the higher time frame PD array and closed back inside, showing signs of strength. Okay, but Dixie didn't took out its equal highs. However, in normal circumstances, Dixie should have taken out these highs and closed back inside, but it didn't took out the highs. This is a sign that Dixie is the weaker pair and we should start for looking shorts on the green dot. Simple. This is the inverse correlation SMT divergence. We studied two types of SMT divergences. First was symmetrical correlation, in which we saw pairs which were directly correlated and moved in the same direction. Second type of SMT divergence is inverse correlation, in which we saw pairs that move in the opposite direction, such as Euro USD and DXY. Now let's look at some common occurrences of SMT divergences in crypto, forex and indices. However, the SMT divergences are not limited to this, and you can find different type of divergences, but these are some of the most common and that I use in my trading. So first of all, let's come on to crypto. Crypto pairs are mostly symmetrically correlated. That means they will move in the same direction as BTC. And the first scenario that we are going to see is of weakness in symmetrical correlated pairs. You can see BTC was creating lower highs. However, ETH created a higher high type of a structure, but it was a liquidity sweep and it showed weakness here and closed back inside. This showed that the overall crypto market was bearish, as although ETH was creating higher highs but BTC was creating lower lows. This means we should either start shorting BTC at this point or start shorting ETH as soon as it closes back inside the higher time frame PD array. And what would be the higher time frame PD arrays? This could be the fair value gaps, order blocks, and equal lows and equal highs, structural lows and structural highs, which we have studied many times in the previous video. Second type of symmetrically correlated SMT divergences that can occur in crypto market are for strength. Let's suppose BTC is creating lower highs and hasn't taken out its higher time frame PD array equal lows. These were the equal lows which BTC couldn't help to take out, but Ethereum was able to take out these lows and created a liquidity sweep structure by closing back above the higher time frame PD array again. So in this scenario, you should look to long ETH. Okay, so either long ETH or long BTC according to your preferences. I usually long BTC or the pair that hasn't swept the liquidity, because that is the stronger pair in my opinion. But you can long either ETH or BTC or any of the pairs that are SMT related. But I usually prefer to long the pair that hasn't taken out its liquidity. So now let's move on to some common SMT divergences in Forex. In Forex, we have both type of divergences, symmetrically correlated and inverse correlated. First up, we will be seeing symmetrically correlated examples. Let's suppose we have a pair such as Euro USD and another pair such as GBP USD. You can see Euro USD was creating lower highs and didn't take out these equal highs. What was GBP USD doing? GBP USD took out its equal highs and gave a liquidity sweep structure. Here you can see weakness as it closed back inside the higher time frame PD array. What could have you done here? You could have either shorted Euro USD or GBP USD, but my preferred way of doing it is I usually short the pair that hasn't taken out its liquidity. So I would have shorted Euro USD, as this is the more weaker pair. So I hope this makes sense, and this is the example of symmetrically correlated Forex pairs in a weakness scenario. Now let's look at an example of a strength scenario when Forex pairs are symmetrically correlated. Here you can see Euro USD was creating lower highs. However, GBP USD liquidity swept its equal lows. Here these were the equal lows. GBP USD swept it and closed back inside, giving signs of strength. Here you could either long Euro or GBP, but I usually like to long the pair that is lagging or hasn't swept the liquidity, which is Euro in this case. Now let's move on to the scenario in which Forex pairs are inversely correlated and see SMT divergences. What does inverse correlated SMT divergences mean? That if one pair goes up, the second pair or the correlated pair goes down, and this type of SMT divergences are usually seen when we compare pairs such as Euro USD with pairs such as DXY. So let's look at an example of weakness for dollar index or DXY. Here you can see dollar index was creating lower highs and did not took its equal highs. And here you can see GBP USD took out its equal highs, those equal lows, those were here, and closed back inside the range. This gave you a trigger to either long GBP or short Dixie. As they both move in opposite directions, you can see Dixie created lower highs and wasn't able to take out its equal highs that were present here. However, GBP USD took out its equal lows that were present on this dot, but Dixie wasn't able to take out its equal high and was moving towards the downside. If I was you, I would have shorted Dixie because it didn't took out its liquidity and hence was showing more weakness. However, GBP USD took out the equal lows and closed back inside, showing signs of strength. So you could either have shorted Dixie or long GBP USD. Either way, you would have made a profit. Now let's come on to a scenario in which we see strength on the Dixie chart. As you can see, we are forming lower lows on the Dixie chart and we didn't took out these equal lows. However, on the GBP USD chart, which moves inversely correlated to the Dixie chart, we took out these equal highs and closed back inside here. This could have been a possible short on GBP USD or a long on Dixie. So this marks the end of the inversely correlated scenario in Forex. Now let's move on to our SMT divergences in indices. Indices also have SMT divergences that are symmetrically correlated. That means they will move in the same direction. We can see the SMT divergences for weakness. You can see here ES was creating lower highs and didn't take out its equal highs. This created an SMT divergence as NQ took out its equal highs, closed back inside, creating a liquidity sweep scenario, and you could have either shorted ES or NQ. I would have preferred ES because it is the weaker pair and hasn't taken out its liquidity. Now let's look at a scenario where we see strength in indices through SMT divergence. You can see ES was creating lower lows and you saw that NQ took out these equal lows and closed back inside, giving us scenario of liquidity sweep. Here I would have longed ES because it is a stronger pair and hasn't taken out its higher time frame PD array or the equal lows present here. Now let's move on to the last topic, that is the high probability way of trading SMT divergences. So I have identified 4 steps to trade SMT divergences in a high probability way. First of all, identify the higher time frame trend, either bearish or bullish. Second step would be to mark the nearest 4-hour PD arrays or equal highs or equal lows. Thirdly, wait for SMT divergences to occur and to gauge the market strength or weakness. Fourth step would be to execute the trade. Let's look at an example. Now this is an example in which we will be considering inverse correlation SMT divergences, and we have the relationship between Dixie and Euro USD in this example. So as you can see, first of all, we will be identifying the trend. Dixie is in a downtrend. As you can see, it is creating lower highs and lower lows, lower highs and lower lows. So I was expecting a counter trend move to at least towards this bearish fair value gap, as we were tapping in this bullish FVG. So I was expecting a counter trend move on Dixie towards at least this bearish FVG. Now let's look at the Euro weekly chart. You can see Euro was in an uptrend or bullish trend, creating higher highs and higher lows, and I was expecting another higher low here, as there was a weekly OB in this area. Also, I was expecting some sort of retracement on Euro, as there was a bearish FVG here. So my overall bias was clear that I was targeting counter trend moves on Euro USD or Dixie and was looking for SMT divergences to gauge the strength or weaknesses of the market. Now let's move on to a lower time frame such as the 4-hour. Here our second step will be fulfilled, where we will mark the 4-hour equal highs or the 4-hour PD array. These are the equal highs on Dixie that I would be targeting if I am trying to play the counter trend move. Similarly, on Euro USD, I have some equal lows on the 4-hour that I will be targeting if I try to play the counter trend move. Now let's wait for the SMT divergence and market to give a signal for me to short. Here on the 1-hour chart, if you can see, Dixie took out these lows and closed back inside. This was a liquidity sweep and Dixie took out these equal lows. Equal lows were taken and closed back inside. This was a sign of strength on Dixie. So I could play my counter trend move. In the same time, if you see on the Euro chart, we could see that Euro was unable to take these equal highs. So what did I do? Which one is showing more weakness? Euro. So I tried and shorted Euro from this area and placed my stop loss above this 4-hour inverse fair value gap. Simply targeted a 2 to 3-hour trade. And how did I did it? Firstly, identified the trend, then identified the 4-hour highs and lows, then executed on the 1-hour SMT. Simple. As you saw that SMT was just a way for me to gauge the market, not an execution or entry technique. So I hope you like the video.